Scene script. Buckle up for an economic roller coaster ride as we dive into the shifting landscape of U.S. corporate debt. Are you ready to talk numbers? Let's do it. Recently, there's been a seismic shift in the behavior of U.S. companies. Rather than hunkering down in fear of a deep recession, they're issuing more debt and buying back their stocks at an accelerated pace. Let's illustrate this with some figures. In December alone, around $23 billion of U.S. investment-grade bonds were issued. That's not a small change in the piggy bank, is it? Moreover, dealer inventories of these bonds have risen to $8 billion. That's a significant uptick, signaling a confidence in the economy that we haven't seen for a while. But that's not all. Non-financial firms, and we're excluding the mega-cap tech firms here, have spent a whopping total of $87 billion on stock buybacks in the last quarter. That's the largest increase in stock buybacks since late 2021. Why is this happening, you ask? Well, it seems to be a blend of fading recession fears and expectations of lower interest rates. Companies are willing to take on more debt, expecting the cost of that debt to decrease in the near future. But hold on, it's not all sunshine and rainbows. Experts caution that the risk of a downturn still exists. If the U.S. manages to avoid a steep downturn, interest rates may remain higher for longer than expected, which could add a twist in this economic tale. This shift towards new debt is a stark contrast to the trend last year, when investment-grade companies were focusing on deleveraging their balance sheets. Let's switch gears and talk about the role of interest rates in this shift. Interest rates have always played a pivotal role in influencing corporate financial decisions. When rates are low, businesses are more inclined to borrow, investing in growth and expansion. In the recent past, we've seen a shift in corporate debt behavior, largely attributed to fading recession fears and expectations of lower interest rates. However, it's important to remember that the risk of a downturn still exists. The economy is a complex, interwoven tapestry of variables and uncertainties. If the United States manages to sidestep a steep downturn, interest rates may remain higher for longer than anticipated. This could potentially alter the corporate debt landscape once again. But what does this mean for businesses and consumers? For businesses, higher interest rates could mean more expensive loans, which could deter investment and growth. It might also make it harder for businesses to service their existing debt, leading to potential financial difficulties. For consumers, higher interest rates could mean more expensive mortgages and other loans. It could also increase the cost of credit card debt. However, on the positive side, savers might see a better return on their savings. In essence, the interest rate environment has a ripple effect on the broader economy, influencing everything from corporate decisions to consumer spending habits. It's like a dance, with businesses, consumers, and the economy moving in response to the rhythm of interest rates. In the end, the dance between corporate debt and interest rates is a delicate one, and the music hasn't stopped yet. Now, let's talk about the end of easy money and its impact on stock market gains. We've entered a new era, folks. The Federal Reserve's rate hiking campaign has drawn the curtains on the era of easy money. This isn't just an end of an era, it's a seismic shift that's causing companies to pull back on their stock buybacks. Let's take a moment to understand why this is happening. Bank of America strategists have sounded the alarm, warning that buybacks are at risk. The culprits? Tighter credit conditions and an increased cost of capital. As these factors make it harder for companies to borrow, the ease with which they could boost their stock prices through buybacks is diminishing. This shift hasn't been subtle. In fact, buybacks have already taken a hit, with a substantial 26% decrease in the second quarter compared to the same period the previous year. The tightening of monetary policy and the increased cost of borrowing have made it more challenging for companies to raise debt. Interest rates, the lever that controls the cost of borrowing, play a pivotal role in this scenario. Higher interest rates mean higher borrowing costs, which can discourage companies from taking on additional debt. And if companies can't raise debt as easily as before, they will find it harder to buy back their own stocks, thus limiting their ability to boost stock prices. So, what does this all mean for the future? Well, the spread between earnings yield and corporate bond yield is indicating a future where buybacks may be more muted. Policymakers, grappling with inflation that's stubbornly above their target, are unlikely to slash interest rates anytime soon. A resurgence in rising prices could disrupt both stock and bond markets, adding another layer of complexity to the situation. As the era of easy money comes to an end, it's clear that the landscape for stock buybacks and corporate debt is changing. We've covered a lot of ground today, from the shift in corporate debt to the impact of interest rates and the end of easy money. We've seen how U.S. firms are re-leveraging, issuing more bonds and adding fresh debt. We've uncovered how interest rates and the end of easy money influence these decisions. But remember, the economic landscape is ever changing. The best we can do is stay informed and prepared. So for more insightful discussions on the economy, don't forget to hit that subscribe button. Until next time, keep your eyes on the market.